Hello, everybody, and thank you for joining us today for our China Update webinar, which is an update on Q1 2025. For those of you that I don't know, my name is Murray Anderson, based in Cape Town, and sitting in Shanghai with us today, as usual, from our Prescient China business, Tian, who's Head of Strategy and Product, who will be presenting today. Thanks everybody for joining. Our presentation will probably be about 35 to 40 minutes. We'd like you to post questions in the chat, if you don't mind, which we'll address at the end. So what we'll do is I'm going to go out of focus, listen in the background. Tian will deliver his presentation, and then at the end we'll have some questions. So again, thanks everybody for joining. I'm sure you'll enjoy the content of the presentation. There's lots to talk about. Obviously, you've seen the resurgence of China shares. I think that's to a lot of excitement of investors that have been invested in the Prescient China funds, particularly our balanced fund, whether that's through the fund of funds option or the feeder fund option or the offshore US dollar-based option. So as I say, lots of exciting stuff. The geopolitics, which is playing out, is obviously front and center, and that's effectively what Tian will cover today in the presentation. Tian, over to you, and thanks for the time.
Great, thank you, Murray. Morning, everyone. Thank you for joining our first webinar of 2025. Lots to cover. A lot has happened since our Q4 webinar last year. I'm going to jump straight in. So I think the first part of today's webinar, I want to cover something. It was a 10-year plan enacted by the Chinese government 10 years ago. So we are pretty much at the end of that 10-year plan, and that project was essentially planned was called Made in China 2025. So seeing that as the first webinar of 2025, we thought we'd cover how China did with that 10-year plan. And a couple of reasons why we thought we'd cover Made in China 2025 is we've seen a lot of coverage of China being an authoritarian regime, a non-democratic regime, but we often don't consider the positives that comes with a competent single-party regime, which China is. Our view, which has been consistent probably since we've been in China, is that the Chinese government is extremely competent and efficient in a lot of things that they do, and not that they are perfect, but in terms of economic planning, this Made in China, I want to take you guys through what China has achieved over the past 10 years. So it's some selected highlights of what China's been able to achieve throughout this 10-year plan to upgrade its economy. Pretty much, I think the first thing we need to note is that 2017, 2018 was when the China-US trade war and US tech sanctions on China started. So if we summarize China's achievements, they've been able to achieve about 86% of the objectives under this 10-year plan. So doing very, very well under very tough global conditions. And when I say global, largely US tech sanctions. China is now the leading EV producer and exporter of the world. Last year, China became the largest automobile exporter in the world with 6.4 million cars exported. So widening its gap or its lead over Japan, being the second largest. The photo on this slide is two Chinese-made passenger airplanes. So the one on the right is the smaller and older ARJ-21 plane, and the more significant is the one on the left. It's the Chinese-made COMAC C919. So it's a direct competitor to the Boeing 737 and the Airbus A320. So it's your narrow-body regional aircraft. That's quite a major achievement. So it's now only the third region in the world that's able to produce aircraft. So in addition to Boeing of the US and then Airbus is a combined European effort. China now can produce their own airplanes. If we look at another highlight, I think China has really become an energy leader of the world. So across all sort of forms of energy, China now has the most efficient coal power in the world, with the least pollution on aggregate. Arguably, China has the newest and best nuclear power technology. China has by far the world's biggest green energy production. So that's a combination of hydroelectric units, solar power, wind power, and it's able to transmit power with long distance high voltage transmission systems where they can transmit power generated inland thousands of kilometers away into the coastal cities where majority of the economic activity happens. So that's also something that's been in the plan for the long term. If we think about China being the EV leader of the world, the amount of electricity all of the new electric vehicles will consume, it needed to take a lot of planning in advance. And this just shows the amount of planning and the amount of efficient implementation by the Chinese policymakers. So all of these positive developments, China now has its own developed and run Beidou satellite system. So we all know of GPS and GLONASS being sort of the American and the Russian / European navigation systems. Beidou is now the most accurate commercially available system, largely because it's the newest system available. But in all of your new iPhones and Samsung phones and your Garmin smartwatches with navigation, you will start to see Beidou in the specs. It's all compatible with the latest devices. More symbolic, I think China has made multiple moon and Mars landings. Nothing much in terms of direct economic impact, but symbolic in terms of its scientific achievements. If we look at China in 2015, it was largely a low value add, low margin, labor intensive industries, and where we've progressed over the past 10 years, China has really moved up the value chain and really moved into higher margin, higher tech, higher R&D intensive industries, like the photo shown on the right hand side of this slide. So the upgrade has been very, very successful. But there have also been parts where China have not been able to achieve their stated objectives. So for example, advanced semiconductors. The US holds the most advanced semiconductor technology, with TSMC as Taiwan Semiconductor Manufacturing Corporation being able to produce the most advanced semiconductors in the world. China is a few generations behind. China is also not able to produce the most advanced photolithography machines. Photolithography machines are the machines that you need to build or produce the most advanced semiconductors. So those are the two things China have not been able to achieve over the past 10 years, largely due to US tech sanctions by the US and its allies. In all estimates, I think quite wide ranging, but in all likelihood, we'll probably see China catch up to the latest semiconductor technology, both in terms of semiconductors and in terms of photolithography machines in a 2 to 5 year time span. So China is about 2 generations behind currently the most advanced. And every generation is sort of 1 to 3 years, depending on how fast you progress. Other things China haven't been able to achieve: intercontinental passenger jets. So your larger intercontinental jets like your Boeing 787 and your Airbus A350s, they are underway. Development of those airplanes are underway, and it's just a matter of time before it comes through. And then fully autonomous driving. I think that's been a global issue, more due to passenger safety and regulatory issues. Technology is very advanced in China already, but still not fully available across the nation. There are certain pilot zones where you have fully autonomous driving, but we're still some time away from full commercial launch. So if we look at China's tech advancements in pictures, this is a visually interesting slide. This is the Huawei trifold phone. I'm not sure if many of you have seen it in real life. We have seen it in the Huawei showroom. Not a very practical phone, but it's the world's first and only trifold phone. Many of you would have seen the Samsung fold-out phone. Huawei, Xiaomi, and Oppo also have their single fold phones, but not a folding phone with 3 screens. So Huawei doing well in terms of technological advancement. This is the Huawei car. So for those of you that do not know, Huawei, with its sanctions by Google, unable to use Google's Android system, went on to develop their own Harmony OS, which is sort of a hardware agnostic. So they have their Harmony OS on their phones, on their tablets, on their laptop computers, and also they've got their Harmony OS system, or not necessarily called Harmony, but the entire OS system for smart cars. So this is the flagship Huawei M9 SUV product. It's a very large SUV, similar in size to your BMW X7 or Mercedes GLS product, so a very big car. You can look at the interior, very, very top-notch quality. So we have taken, for those of you that have traveled with us before in our China tour last year, we specifically took investors to the Huawei showrooms to see the interiors and the exteriors of the cars. This specific car costing in the domestic Chinese market about 1.3 million rands, converted into US dollars, about 75,000 US dollars. So very affordable, very good price for its category. If we look at other cars, these are two BYD hatchbacks that have recently been launched, Sea Leopard 06. So these retail for about 100 to 120,000 CNY. So that translates into top spec being about 350,000 Rand, or about 20,000 US dollars. So under 20,000 US dollars for these cars. So there's a reason why BYD is just doing exceptionally well on a global scale, especially in emerging markets where its cars are very competitive, both in terms of product quality and price. Moving on to other products, we have companies like DJI that's absolutely dominant in their segment. This is the DJI Osmo Pocket 3, sort of your gimbal camera product. And then these are DJI drones. DJI commercial drones have over 60%, almost 70% of global commercial drone market share. They continue to dominate the segment, and they continue to innovate with their products. So this photo is of their agricultural drones, more applicable to markets like South Africa. China overall, really upgrading its entire economy to high-tech products from the olden days of low-value add products. And the topic of the month, probably of the year, is DeepSeek. DeepSeek really bring an entire new perspective into the AI market. We have incorporated DeepSeek into our internal quantitative models, and given our use case scenarios, we have certainly found it to be the best Chinese model out there, and almost as good as the best OpenAI products. And we are paid subscribers of many AI models in our business. So it's certainly probably as good as the media headlines make it out to be, and at about 1/30th of the cost. So to give an idea, for every US dollar of tokens we spend on ChatGPT within our in-house use, it's about 3 to 4 US cents for DeepSeek. So it's extremely, extremely competitive in terms of cost, and it's fully open source. So it's an absolute disruptor in the market. It's going to be very interesting to see how the US AI companies do after this. I think everybody will adjust, given that DeepSeek is open source. Everybody can learn from DeepSeek, and the industry can move forward in terms of tech advancements. So if we look at, with that DeepSeek comment, we look at this chart, many of you would have seen from our previous webinars. This is updated to the end of January 2025. This is after the DeepSeek sort of mini crash in NVIDIA. The NVIDIA with about a 2.9 trillion US dollar valuation in terms of market cap. And on the right-hand side, we have Tencent at 470 billion. They're slightly higher now, but not much different. Alibaba at over $200 billion. If we add all the other top Chinese tech names, this is the entire Hang Seng Tech Index, we get to about 1.5 trillion. We're slightly higher than that now, end of February, because it's rallied a bit in China. But still, NVIDIA about 2 times the valuation of all the tech giants that dominate their sectors in China, which is why we feel Chinese market is very, very attractive. Or on the other hand, we feel the US tech sector is quite overvalued. Effectively, you can sell half of your NVIDIA exposure and buy the entire Chinese tech sector. So I think DeepSeek's impact is more to question the valuation of the US tech sector, and also question why the Chinese tech sector is so cheap. So since we did this chart end of January, we've obviously seen major rallies in stocks like Chinese tech stocks and AI leaders like Alibaba and Tencent, which has also helped drive the JSE higher. So we'll see in the next few slides where I cover returns. But with that, we want to move on to Trump 2.0. I want to just point out that the photo on the background of this slide is generated from our in-house AI engine with a lot of prompting, and it looks very, very realistic. So we're quite happy with it. Although generating photos is not our main use of AI. But looking at Trump 2.0, there's many positives since our last coverage. So what we are seeing now is that tariffs imposed by Trump is currently only 10%, down significantly from the 60% he talked about during his campaigning. There could be more tariffs coming through, but we are a long way from 60%. There's been quite a lot of active communication between Trump and the top Chinese leadership, Trump's team and top Chinese leadership. And we believe Elon Musk currently will be a very positive contributor. Elon Musk is highly respected in China, both in the business community and within government. He understands China very objectively, and we believe he'll be a rational bridge between the Trump administration and top Chinese leadership. So we expect for as long as Elon Musk is in office, that bilateral relations between China and the US will be stable and shouldn't have any irrational declines running out of, or sort of spiraling out of control, like some scenarios we saw under the previous Biden-Harris administration. So we quite positive in terms of China-US relations in the short term. If we look at a lot of the headlines since Trump has come to office, I mean, we've seen positive and negative headlines. First, a handful of positive headlines where Trump had originally held off on tariffs, Trump unbanning TikTok, which is really seen as positive gesture for Chinese businesses. Trump wanting to do an official state visit to China, which is still potentially in the works, meaning bilateral relations shouldn't sort of deteriorate at least until after the official state visits as a minimum. And then recently we saw Trump pretty much trying to toughen Biden's chip controls over China and really trying to sort of tone up the media noise or the narrative. But in reality, I think headlines like this one, where she has voiced support for the private sector and the tech sector in China, has really made the difference in Chinese markets. If we look at year-to-date returns in China, this is US dollar returns up until the end of yesterday. So up until market close on February 26th, we can see that Hong Kong or China H absolutely dominant. So China H almost doing 20% in just a little bit under 2 months. I mean, we are one more trading day to go. Hong Kong was slightly down today, but overall, absolutely the best performing market in the world for 2025 so far. The US with 1.5%, obviously South Africa up 8%. A lot of that 8% driven by the growth in Tencent. UK also doing well. And then if we look at MSCI China, MSCI ENX China, it's only down 2.2%. India actually negative 6%. China onshore is where it's been pretty flat. So we're actually waiting for potential announcements from NPC meeting. So the big disconnect between China A and China H is that it's really only the tech sector that's rallied in China so far. And we are waiting. We're very bullish on the entire market. We've seen a lot of positive news come through on the tech sector. That's why it's rallied, especially obviously DeepSeek and President Xi Jinping meeting with tech leaders. But we do believe the onshore China A market has a lot of potential for catching up. So yeah, it's probably not a bad time to add exposure to China A just because it's lagged Hong Kong and fundamentals are strong. I'll show fundamental economic data shortly after these slides. But overall, China on average, if you average out China A and H, the best performing market in 2025 so far. Under Trump 2.0, China continues to dominate, and this is part of the fundamental economic data I wanted to show, is that if you look at the light blue line at the top, Chinese rolling trade balance numbers or rolling trade surplus just continue to dominate the world. It continues to grow. If you look at traditional industrial and export powerhouses like Germany, Japan, and South Korea, they are all struggling or stagnating. If you look at Japan, it's struggling with a consistent trade deficit. Obviously, we've all seen the news of the yen weakening over the past couple of years. If we look at China's annual total trade surplus on the right-hand side, if I didn't show everyone that the Trump tariffs began back in 2018, one probably could not tell anything went wrong with China's annual trade surplus. It's just showing linear upward fashion growth. So very strong growth, even in the face of all the US tariffs and US sanctions. China doing really, really well. Moving on to the latest economic data coming out of China. For those of you that have joined our previous webinars, you'll know that I color code all the latest data points. And for this quarter, or specifically the December, January months, we actually have 0 red color coding. So everything is either positive or neutral, which is very, very good to see in terms of economic recovery in China. Q4 GDP growth was very strong at 5.4% growth year on year, taking overall 2024 growth to 5%. CPI is very, very encouraging. So both CPI and core CPI jumping. We were pretty much around 0 for a couple of months, really flirting with a deflation scenario, but we've jumped from 0.1 to 0.5 in CPI and 0.6 in core CPI. Core CPI is its 4th month of consecutive growth. Ideally, we want to be in the 1 to 2% range. Right now, we are getting there. We are getting away from 0, which is very important. PPI pretty flat in December and January, so minus 2.3, unchanged from December, but still less negative than October and November. So that's a positive development. It's color coded yellow because it's not positive PPI, it's still negative PPI. If we look at retail sales, December numbers, these are December numbers. So it beat estimates, nothing amazing, but it's starting to beat estimates and it's growing year on year. So that's a positive development with consumer confidence coming out of its lows the past couple of years of property and COVID declines, etc. Exports year on year, very strong in December, largely due to inventory buildup prior to the expectation of Trump tariffs. So we do expect export growth to slow temporarily, at least, until growing stronger again, second half of the year. We'll see the new data points coming out in the next couple of months. Vehicle exports, I mentioned earlier, 6.4 million units for 2024, 23% increase year on year. So very strong increase year on year. New home prices, it's negative 5.3%, but it's color coded green because it's the first time we've had consecutive months of slowing price declines in the property market. So we are seeing signs of stabilization in the declining property market. There are certain economists that have called the property market has hit a bottom. We don't believe we are really at the bottom yet. We don't necessarily believe it will drop further, but we believe the entire property sector and its related sectors will continue to be a drag on the economy. Not to say the economy won't grow, but it will impact economic growth probably for the next at least 5 to 7 years. So we continue to monitor property. In terms of our portfolios, we are pretty much completely free of property-related stocks. So we are quite comfortable with our portfolio position. These charts pretty much what you want to focus on this chart is where it's circled on the right-hand side. We are seeing an uptick in terms of CPI and core CPI. Core CPI is the pink bars in the background, and consequently, we are seeing a slight sort of increase in China 2-year rates, slightly above the 1% mark. Real rate scenario is still fairly healthy, so there's no negative real rates. PMI pretty much hovering around the 50 mark. There's nothing too much to interpret. When markets are declining in China, media headlines typically call China's PMI as the reasons for the decline, but it's pretty much stable, either slightly above or slightly below 50. So industry confidence in China fairly consistent, nothing great, nothing terrible. This chart is a chart that's quite important to look at. So the larger the bar, the worse it is for the economy. So if we look at prior to, this is annual China household savings. So prior to 2019, prior to COVID, we saw average annual household saving around 6 trillion CNY, or just a little bit under $1 trillion US dollars. 2022 was its peak. 2022, we saw Chinese households save a record 18 trillion CNY. So that's almost 3 times as much as the historical average. So that means on average, 12 trillion CNY did not get spent or used in the economy to help the economy grow or help GDP. So that's a very negative big bar there. So we want these bars to decline going forward. And the trend is looking positive. 2024, we are at just over 14 trillion, but we still need another 8 trillion per annum of savings to be unlocked, to be spent or invested in the economy. That will really help push through economic growth and push through corporate earnings. So the cash is there, and we are starting to see policies to sort of support consumption and to really motivate consumers to spend money. So that's a positive. We are already seeing sort of a lot of consumption vouchers where the government subsidizes between 15 and 20% of home appliances and electronics. So for example, you can go right now downstairs. Our offices are above the mall. I can go downstairs to the Apple shop, buy an Apple Watch, and the government will subsidize me 15% of the value of that Apple Watch, which is discounted immediately to the amount that I pay. So those are really positive policies coming out across China. So hopefully the numbers will get better in terms of savings. Overall retail sales, this is not a great looking chart. I think the important thing is that it's flatlining above zero and it's stabilizing. We're not seeing sharp volatility in terms of retail confidence. Slight uptick on the right hand side of the chart. If we look at tourism numbers, so we were waiting for Chinese Lunar New Year trips, which was earlier in the month, we are seeing solid increases. So we are seeing 2025 increasing from 2024, both in terms of the number of trips and total spending. So we are now properly, so last year, if we focus on the chart on the right hand side, last year's total spending was 7.7% ahead of 2029 numbers. This year we are 32% ahead of 2019. So this year we're 32% ahead of 2019 total spend numbers. So all the numbers are upward trending. People are beginning to spend again. Retail confidence is returning. So we really believe we are out of the bottom and on the way up, which is why we are very bullish on the Chinese market. Moving on to the section where we always try and cover, there's always this question of whether China is investable. We obviously have no doubt that China is investable, but just looking at valuations, end of January valuations, China, the 2 red bars, in comparison to India already coming off its highs, it's still almost more than double the valuation of China H and about 50% more expensive than China A. S&P even more expensive, Japan also more expensive than China on average. Those are the 3 of the hottest markets right now. If we look at sort of comparisons at a single company level, this is BYD versus Tesla. So similar companies in sort of electric car manufacturing, into the power storage. We look at some simple metrics in terms of PE ratio. This is as at the end of January 2025. BYD had a PE ratio of 29, which is already not cheap. Tesla's PE ratio is 162. BYD's PB ratio, price to book, is 6, Tesla at 16, and price to sales, BYD at 1.5, and Tesla at almost 12. So you can see the massive valuation differentials, which also speaks to my previous slide, comparing NVIDIA to the entire Chinese tech sector. We just believe a lot of the US valuations are excessively high, and on the contrary, Chinese valuations are excessively low. So we believe there's probably a lot of room for Chinese companies to revalue upwards and quite some room for US companies to revalue downwards. On a cyclically adjusted basis, we see India and US at pretty much all-time highs over the past few decades. China, even with the recent rally, this is China A, pretty much close to its all-time lows. That's why we believe there's a lot of upside for the Chinese equity markets. On average, China's on a 60% discount to the US and India. If we look at last year, we always think we've been, at least China, going through a bit of a bear market over the last few years. You kind of always have this emotional backdrop of China just always declining. But last year, China was actually one of the best performing markets in the world. So if we average out China ANH, China did about 20% last year. US was the best performing at 25%, but China was by far the second best performing market in the world. But I think a caveat is that pretty much all of the returns in China last year came through a 1 week period between end of September and early October. And this slide tries to show that you cannot time markets successfully over time, especially a market as volatile as China. So the table on the left, or chart on the left, is China A, chart on the right is China H. So stimulus announcements were made on the 24th of June, 24th of September last year. So the assumption here is you had cash lying around. So we have buy on 26th, buy on 27th of September. So if you had cash in South Africa lying around and you wanted to buy into China and you subscribe to our funds immediately on the 24th, you would probably get in by the 26th of September, which is typically a 2-day lag from when you implement to when you get exposure. In China onshore, for those 2 days, you lost 7.5%. The more significant is on the right-hand side. If you missed those first 2 days in Hong Kong or China H, you lost 28% of the 32% return that you had that year. These charts are quite extreme examples, but very recent examples to show that one can really not successfully time the market, especially a market like China, and the importance of just maintaining exposure in a market like China, especially at current valuations. So this year, again, for example, we're not sure what the market's going to do for the rest of the year. If the Chinese tech sector flatlines for the rest of the year, basically the month of February would have generated all of 2025's return. We certainly believe there's quite a lot more upside, but you never know how the market's going to perform. So it's really important. Again, we stress the importance of maintaining consistent exposure in China. Looking at Prescient, this is our asset allocation throughout the entire 2024. As at the end of January, we were very aggressively positioned, about 91% equities. We're about 93% equities as I speak, so slightly higher than what this chart shows, with a heavy overweight to China tech. So our Prescient China Balance Fund really outperforming 100% onshore equities as well. This was our performance last year for 2024. So this is not comparing ourselves against our benchmark. This is giving us a higher sort of compare ourselves with a more difficult task of trying to keep up with 100% equities when in a year where markets are up. So last year we managed to achieve about 93% of equity market upside, which is pretty good for a strong up year for the Chinese equity markets. This year, 2025 year to date, this is as at the end of yesterday. So we are up 4.8% compared to onshore equities, which is only up 1.4%. So far this year, we are beating 100% equities in the Chinese market. So our overweight in China tech really helping us. So for all of our clients in the Prescient China Balance Fund, we've had a good 2025 so far. We still have a lot of the tech rallies returns in February to be unlocked because we do hold option structures in our Prescient China Balance Fund, and a lot of the returns get unlocked as we get to maturity of our option structures. In terms of Morningstar ratings over long term, we continue to be 5-star rated. Over 3 years, we expect that 3 stars to get better as the equity markets get back. So we are in the category where there are also multi-asset funds that with a heavy fixed income focus. So with Chinese equity market doing negative absolute returns over the past few years, we have fallen behind in the 3-year rankings, but as the markets recover, we expect to regain our 5-star rating. In terms of our since inception performance up until the end of January, this is again comparing ourselves to 100% equities, total return indices. And this is the MSCI emerging markets over a 12-year period. And this is MSCI China, the gold line, and CSI 300 China A, the red line. Our Prescient China Balance Fund has outperformed all of these 100% equity indices net of fees. So this is with all fees taken off. We've beaten MSCI emerging markets by 78%. We've beaten MSCI China by 79% and CSI 300 by 53%. I just need to reiterate these 100% equity indices are not our benchmark. We benchmark against CPI, and we typically compare ourselves to a 65% equity and 35% fixed income reference index. So we've beaten those indices by such a wide margin that now we're starting to compare ourselves to pure equity indices. We'll continue to try and beat 100% equities in China. We won't necessarily always be able to achieve it, but this chart shows the consistency of our capabilities in China and our track record. So in summary, I think Chinese economic recovery is very, very strong, and sentiment has turned strongly positive. So that's very good. China is just a market too big to ignore, and it's the best diversifier for SA-based investors. So we continue to encourage everyone to seriously consider China as a market. Current valuations are very, very attractive. And for a market as volatile and as big as China, we believe that the key to success is a robust, active investment process that can consistently generate alpha. And obviously, we'd love it if you guys would consider our China products. And I understand many of you are already invested. This is a chart that shows the up and down cycles. We've shown this chart a couple of times. We do believe from current levels, we have a lot of upside. The green circle is where we are, even with the recent rally. We are still pretty much at the bottom of the cycle, but a big upside to come. We don't expect sort of the 616% we saw in 2006, 2007. The market has matured and there's less concentration, it's more efficient, but we do believe there's big upside. It's currently where we currently are. So with that, I think finish of the presentation, open to questions. Please feel free to type questions into the chat, and we can try and answer any questions that you.
Thanks, Tian. While you quickly cast your eye over the questions that have come through, I think there's a lot to talk about. I mean, your start of the presentation was based on the fact that the 10-year plan has played out. I think this quality China 2025 is certainly something that we've seen in the product. Options that are coming out of China. I've had the great experience, of course, of being in China with you and visiting some of the EV manufacturers, and we can just obviously attest to the quality of these products, as well as the phones. Huawei and their products, Xiaomi and the various cell phone products and home products that they're bringing out, and obviously their vehicles of late have been extremely interesting to see. Then obviously I think the other points that we can delve into a little bit later on, post the questions in Trump 2.0 and what's going on in the IT sector. But I think a couple of the questions here are linked very much to the debt levels, and I think the first one, which you did touch on though, is the property sector clearly has been a drag on the economy for some time. And the one question relates to what's the Chinese government doing to remedy the property sector, where it's gone through this downturn, and obviously there's lots of debt. And I think from a confidence perspective, the consumer has felt the pain of that, bearing in mind that a lot of their savings either is in cash or in property. Just thoughts on the remedy and the execution of solving the overhang of the debt.
Yeah, so I think we certainly have a lot of debt at a local government level, especially in your tier 3, tier 4 cities where there isn't that much organic property model. So I mentioned that is because pretty much most of the debt is historically related to the property sector. And that's why we believe it's going to take a while to solve. So China is not a country like, it's a socialist state. So what the Chinese government publicly states is that China is a socialist country with Chinese characteristics. And one of the key factors of being a socialist state, at least in terms of the Chinese way, is that you can't go bankrupt if you're going to cause major social impact. So unlike in the 2007, 2008 mortgage-backed security collapse and the global financial crisis that started in the US, companies in China, especially the property developers and these local government finance vehicles, can't just go bankrupt and say, okay, I'm not bankrupt, I'm not going to pay back, I'm not going to deliver my properties. What the Chinese central government, sorry, I think I'm just going to stop sharing my screen so you guys can see me better on camera. 1 second. Stop sharing. Okay, so to carry on with the answer, so China is trying to use at a central government level, at least trying to ensure that a lot of the incomplete property developments are completed so that your end buyers will take delivery of property, because pretty much all of those uncompleted properties have been paid for. The buyers are paying their 30-year bonds, mortgages, but they haven't taken delivery. So it's that social consideration within China that's going to cause sort of this entire property bubble and the local government debt issue to continue to be a bit of a drag on the economy. It's still going to grow at around 5%. It's just that without the property drag, we may still be growing at 7-8%, or at least 6-7%. So that's where we are. We don't expect sort of a major collapse in the property sector. There's a clear policy directive to ensure a managed decline and a stable sort of outcome that stretches out. And China, other sectors in China are growing fast enough to help us get there.
Tian, related to that, questions come in, and I guess the point is around government involvement, at a company level and an SOE level, and obviously from a South African investor or any external investor's concern is this significant government control, in a sense, or ownership of the asset, and the concern that has from a property rights, etc. Maybe a comment on that, which is really saying, is it something that we have to worry about? Property rights are important. Can you just take away my shares? Maybe a comment on that front, because obviously, while we can appreciate that government support is good, what's the downside?
It's very much not a concern at all in terms of ownership rights. So we have seen certain, now and again, you see reports of foreign investors. They claim that they're unable to get money out. I mean, we all live in China. As long as you show that you paid your taxes, you can take money out of China. I remember I think it was Mark Mobius that said he couldn't get money out of China. So I'm not sure that there were tax issues. I can't really speculate. But in terms of our on the ground experience, we don't have any concerns of ownership rights, especially as foreigners. Our ownership rights, we feel, are sometimes even more protected than locals. In terms of government influence in industries and companies, I think it's all about packaging. When I say packaging, all about media coverage over the past 5 years. So, for example, I think to start, I think our view is that Chinese companies operating in China, nowhere, especially in 2025, really not different to risk of government intervention in the US, as an example. So very simply, I use 2 big examples in the US. Google, as a first example, they were banned from selling Android operating system to Huawei. The full package, the full Google service version, they didn't have a choice. So what the US government can use, whatever reason, national security, etc. At the end of the day, it's government policy intervention into normal business practices, because it wasn't Google's sort of initiative to stop transacting with Huawei or selling its Android operating system to Huawei's consumer phones. Another example would be NVIDIA, one of the hottest markets right now. NVIDIA cannot sell their most advanced GPUs to China. And that is, again, largely due to US policy intervention. government, US Commerce Department saying you can't export the latest technology. If you look at ASML, same story with their most advanced lithography machines. In China, what we have seen is government involvement in certain companies. So you'll have someone from the government as an independent director on the board to be aware of what's happening in your company. But we haven't seen direct intervention in industries since 2021, where we saw sort of the anti-monopoly regulations come on down tech and the anti-after school, so the educare sector that got hit, and that has since largely recovered. So for now, we are actually seeing way less government intervention in Chinese companies in China compared to US government interventions in both US and Chinese companies. So overall, on a relative basis, China, we're actually very comfortable as the manager be on the ground to know which companies are at risk of further policy or regulatory intervention. And it's part of our job to make sure that we are always ahead of the game for our clients to not have significant impact. So all of you would remember within our Prescient China Balance Fund, we had very little exposure to the online educare. We had very little exposure to no exposure actually to Tencent, Alibaba before their crash. Not necessarily, I mean, we were partly lucky, but it was also part of our process that at the time, those companies were just highly inflated in terms of valuations either way. So if you have been part of our strategies for more than 5 years, we would have actually ridden through those regulatory storms quite smoothly relative to many of our competitors. So overall, to answer the question, we're not concerned about ownership rights in China. We're not too concerned about regulatory intervention. I think what we've seen is the regulators here learning from their past mistakes of spoofing the market and really making investors nervous. They are now going a path of better communication, more transparency, and more advanced notice, etc. So we are seeing positive developments here.
Tian, I mean, obviously China from big brands in the West is important. We know the story around Apple, GM, Tesla being heavily invested in China, not only for the manufacturing capacity, but obviously the size of that market. What's been very interesting is to see the expansion and the speed at which BYD has become the biggest EV producer and exporter to the world. There was a question earlier just saying, look, the property market and Evergrande expansion was built on debt. Obviously, BYD as a company is expanding. It's a growth company effectively and would have lots of debt. And the concern was to say, would you not expect to see a similar outcome for a BYD should sentiment change? I think that just to help answer the question is the difference here is that BYD has significant sales internally in China, as well as being a massive exporter to the rest of the world, particularly Europe. So where the US is not necessarily accepting Chinese vehicles through the front door, it isn't a big market, and the tariffs that are imposed on Chinese EVs isn't material for the US. But they're significantly growing in Europe from a distribution point of view. And even from a South African demand perspective, the number of BYD and other related EVs we see on the South African roads is certainly set to increase. Just again, to further expand on that, BYD's product range is not just vehicles, it's commercial vehicles, it's battery power. They're one of the biggest battery producers in the world. And they also are heavily involved in consumer electronics and the solar industry. So I think it's a massive company. And yes, one would always, no matter who the companies, be concerned about their debt ratios, versus what they're doing from a commercial perspective and the way the revenues are generated. But I think, and please add to this if you have anything, but I think the debt levels in BYD are a function of their accelerated expansion, and one shouldn't necessarily worry.
Yeah, so we're not concerned about BYD debt levels. Very healthy, very standard. And there's one, like you mentioned, Murray, there's one major difference between BYD products and the property sector, is that property sector relied on sort of the property bubble being propped up higher and higher. So you needed land prices to go higher, property prices to go higher to sustain. You needed prices to continuously go up higher forever. Whereas BYD is actually going the complete opposite. They are bringing out value for money products, and it's going cheaper and cheaper for better and better. So to give you an idea, near our offices in Shanghai, to buy a 65 square meter flat, it's going to cost you in the region of 30 to 40 million rand. So to put that into dollars, it's about 2 to 3 million US dollars. Let's say we put a wide range for a 65 square meter flat. The BYD car, the one I showed earlier, costs less than a Volkswagen Polo, and that's the top spec. So it's not necessarily comparable. So we have no concerns about BYD getting anywhere near.
I was going to joke, I've cancelled my transfer to Shanghai. I can't afford the property, but I might come and just buy a car. Tian, it seems like you're frozen. Hopefully you can hear us. But I wanted to go back to this point around the property sector, is that, you know, the government obviously supported it as an industry for growth, and the movement of people from, you know, out of rural areas has been a big supporter of that. But similarly, what we've seen now is this shift in support for the tech environment. And you still seem a bit frozen, Tian, but you hopefully come back into focus now.
I'm back now.
There we go. But what's happened is that we've seen now Xi Jinping change his, you know, approach, and it's well publicized in the press, and particularly the FT more recently, where he's met the head of Alibaba and all of the tech players, including the DeepSeek founder and CEO, et cetera, and what's happening here is, you know, now and I believe it was the first time in the last month that the DeepSeek founders have actually met with the premier and the second in charge. And suddenly the support for the tech sector is significant. And that's what as you've mentioned well throughout your presentation, is the support of the rally in the share prices. I think fortunately from an opportunity point of view, they haven't rallied to the extent as what we've seen in the West, particularly with the likes of the Mag 7. But the point here is that there's lots of legs, and we'll come into the investment case at a fund level. But I think that support has been absolutely significant. And there's, you know, I've tried to keep abreast of the DeepSeek phenomena and what they're talking about. But this is a 30x shift in terms of computing speed and power and cost of running it. And just a couple of points you made is that if you look at the West, the big demand is for power and power utilities to fund or support the growth of the data warehouse and obviously the server farms that are running, you know, your GPUs, et cetera. But where China's now in the infrastructure rollout has got significant power with its solar, you know, hydro, or as you noted, have got the most advanced modular nuclear reactors in the world. You know, they can power this stuff. The challenge has been that you've got this lack of supply of the GPUs, or the extremely thin, fast processing power speed of what TSMC is providing in the NVIDIA chips. But what's significant here is that how long, and this is the question, is how long does it take, you alluded to it, that China actually starts to manufacture their own chips, which are going into the GPUs, and become less reliant on the US NVIDIA chips. I mean, that's a big shift. And I think something all of us need to watch out, because what they are saying about AI, this is like significant societal changes that will happen in the months to come, in the years to come, given the ubiquitous nature of this product. And DeepSeek now is being embedded into literally every sector of the Chinese market, including, and we've seen a massive ramp up in Tencent, which fortunately, I think a lot of investors in South Africa through discretionary and non-discretionary investments are benefiting from, due to Naspers share price rising. I've said a lot here, but I think it's just related to, this is an industry which is exploding, and China is now at the forefront of this evolution. Your thoughts?
Yeah, absolutely. So I think the gesture by Xi Jinping to meet all the tech leaders is positive. That's why we saw market react accordingly. I think this DeepSeek moment just changes the game again. So not necessarily changes, resets everything, because the cost differentials and the processing efficiency is so vastly superior that everybody needs to rethink the game. And because they're open source, everybody has access to how DeepSeek does things. So everybody has now learned what DeepSeek and we actually expect probably better advancements in the industry. So it's going to be very interesting to see it. I'm still concerned about how the entire industry is going to monetize the technology. We still haven't seen a profitable case yet, even at DeepSeek's much lower costs. So it's going to be interesting to see. But valuations in the US are certainly very, very high.
Tian, there was a question that came up earlier on as you were speaking, was around what happens when the Chinese decide that they don't need Apple anymore. And you know that I'm a fan of Android and non-Apple product, but I mean, it's a great question because it's a significant market. And you just look at the price comparison between, for example, something that we've done in our own house, a Xiaomi 13 phone versus an Apple i13, and it's half the price. And the specs are just as good. And I think, those sort of questions are fundamental around, when do they decide, Americans decide they don't want a Tesla and they want a BYD, for example, or whatever it may be. I mean, I guess these are the questions we face. But the opportunity to invest in a market that, as you rightfully said, is very underinvested is the opportunity. So maybe just before we get to the fund discussion, which are a few questions on that, is saying interest rates in China, is there a comment around that interest rates in the next 12 to 36 months, particularly, as well as the bond market? What are the expectations there? And I guess that's linked to the funding rate and the cost of capital to these industries that are expanding. So maybe just a fixed interest comment, and then we'll get onto the equity side of it.
Yeah, so we don't expect interest rates to rise for the foreseeable future. 36 months, maybe a bit further out, but for the next 12 months, potentially more rate cuts in the short term. But certainly no rate hikes until the economic recovery is back to where we want it to be, and inflation is probably about 2% range. So pretty much we expect rates to stay low. Deposit rates will be low, funding rates will be low. So everything in full sort of easing mode to support the economy.
Yeah, and then just to get to the funds, I'm conscious we've got very little time left before the hour's up. People are asking questions around balanced fund versus equity. I think maybe just explain the description of balanced fund and what it actually is versus the equity fund, and why one would select the other versus, equity versus balanced.
Cool. I'm just going to share my screen again, just to talk about the fund. So I'll go on this slide. This is our balanced track record. The slide I showed earlier, since inception. This is a 12-year period, 12 and a half years, almost 13 years. So for retail investors and even most institutional investors, we always recommend an investment into our Prescient China Balance Fund. So the balance name is a bit misleading. For those of you that have followed us for a while, you'll know that our Prescient China Balance Fund is actually a Prescient China flexible mandate. We can go down to 0% equities, and we can go up to 100% equities. That is how we are able to beat 100% equities for more than a decade. So especially for the retail investor and for the institutional investor that do not have your own China asset allocation capabilities, the balance fund is always going to be our recommendation, because we manage the allocation to China onshore, we manage your allocation to China Hong Kong, we manage your allocation to China bonds, China cash, etc. So we do the entire allocation, and the fee is very much similar to our equity fund. Our equity fund is more for our pure institutional sort of clients, where they just want an equity building block and they have their own China asset allocation capability. So for everyone else, we recommend the Prescient China Balance Fund. So it's a very simple answer. I think I saw the questions that said they had investments in our equity fund. I mean, it's not a bad exposure right now, especially because our equity fund is pretty much at least 95% in China onshore, but you're not getting an all-in-one China experience. You're not getting China Hong Kong, you're not getting China fixed income, whereas in our China balance, you're getting everything. And as a retail investor, as a non-super massive institutional, we always recommend that. So I think simple answer to those questions, our China balance fund is the product to select across our product range.
Tian, we're gonna log off in literally a minute. So maybe in closing, thanks for that. I'd also just like to comment that, we often get the question, yes, I'm going to invest in emerging markets outside of South Africa, and I go the emerging market index. And the point that we often make there is that your exposure to China has dwindled substantially in the index, the Global Emerging Market Index. And maybe a consideration is rather to have an outside slice of your allocation in China directly. And the best way to do that, as Tian is saying, is potentially through the China Balanced Fund. We have an offshore UCITS version priced in US dollars, which you can access off the international platforms. And then more importantly, from a Rand perspective, we've got a feeder fund, meaning you can access the China Balanced Fund through our feeder based in ZAR. So those are the two ways that you can get exposure to that. And I think it's important to point out that the Balanced Fund is actually kind of an active equity fund. Folks, thanks for joining. There are a few questions that we haven't addressed, which we will come back to you via email. Thanks everybody for joining us. Another exciting discussion around China and the possibilities, and we look forward to engaging you further on this matter.